Joining me today for this week's last Targets in Focus is ATHANASIOS VAMVAKIDis, Head G10 Currency Strategist at Merrill Lynch. ATHANASIOS, it's great to speak to you. Now, today marks the second day in what is the 20th EU Summit. The markets were not expecting much from it beforehand, but after 13 hours of negotiations, the leaders of the 17-nation currency bloc agreed that euro area rescue funds could be used for sovereign debt purchases without forcing countries to force extra austerity measures. What effect do you think these revelations will have on the markets, and what do you think is the next steps of finding a way out of this Eurozone crisis?
We believe that the impact will be temporary. Clearly, these are positive steps, particularly given the very low expectations. And in terms of the FX impact, what we are seeing is a short squeeze because of extreme short euro positioning and short risk positioning more generally. But the fundamental problems in the Eurozone remain. Many details on the steps that have been decided are yet to be clarified, and we also don't have any progress to move towards a closer union. So not as bad as we had expected the summit, but by far not a silver bullet and not the end of this crisis for sure. The developments in Spain and Italy the next few weeks will really be what will determine how long this short squeeze is going to be.
The euro has shown a brief rally in light of the summit as investors seem to have regained confidence in the currency. But what are your predictions for it against the US dollar in the long term?
I mean, we remain bullish on the US dollar in the short term. Although the short squeeze that we have seen now as a result of the summit might continue for a few more days because we continue being concerned about the Eurozone crisis. We believe that these problems will continue weighing on the euro. Also, we expect that the ECB will cut rates next week, which is not fully priced in yet. And we are also we continue expecting that data, not only Europe but also in the US and in emerging markets, will continue being relatively weak, which will weigh on risk. So all of these developments, we believe, should keep the euro relatively weak. And in the short term, we don't expect any QE measures from the Fed, particularly after the extension of Operation Twist. So all in all, it is not unlikely to see the euro weakening closer to levels 1.2 to the dollar, depending also on the developments in Spain and Italy looking forward, and the negotiations in the Greek program. Then beyond the next few months, a lot depends also on the fiscal cliff in the United States, how it will be addressed, and if the data in the US continue to be weak, and what the Fed will do after Operation Twist 2.
Some analysts have said that with gilt yields near historic lows, the fact that the UK has control of its own central bank and monetary policy makes it a relative safe haven from events in Europe, on a fiscal level if not an economic one. Do you agree with this sentiment? And how do you think the pound will fare against the US dollar in the short, mid and long term?
On the pound, we believe that the policy mix is keeping the pound weak. In a way, there is a very good coordination between fiscal and monetary policy in the UK. Fiscal policy is tight, and in response to that, monetary policy is loose. We expect actually further QE by the Bank of England next week. But it depends on your view. I mean, the long-term view of the pound, one could argue, could be positive if the current policy mix works. If the fiscal consolidation succeeds, then eventually the Bank of England could tighten policies. But in the short term, we expect the pound to remain relatively weak. In the next few months, it also depends on the Fed policies. We may see some strengthening very, very short towards the end of the year, which means that in the short term, this will keep the pound relatively weak. And perhaps having a year horizon even slightly weaker than where it is today. But not substantially so, because we believe that markets are already pricing this.
And finally, I understand you have rather a bullish outlook in regards to the Aussie dollar, Japanese yen. Thanos, what are your reasons for this projection?
Yeah, there, I mean, the yen has become the ultimate risk-off currency, particularly with respect to the Aussie. There, in the short term, we say that the world is in trouble when Japan is its safe haven, particularly because of the substantial fiscal problems in Japan. But in the short term, as long as monetary policies outside Japan are keeping a very loosened stand and are loosening even further, simply based on rate differentials, this is benefiting the yen. So at this point, we expect this to continue. Given that now more or less we are still in a risk-off environment, we should not expect the yen to strengthen substantially from where it is now. Also, there are concerns that if it does so, the Bank of Japan will intervene. Beyond the next few months, assuming the global economy recovers and central banks start thinking about more normal monetary policies, we will expect the yen to weaken. But in the short term, we would expect the yen to remain relatively strong.
Thanos, thank you for your perspective. Sadly, that's all we have time for. Click back for all of today's market news with a look at the week ahead with my colleague Natalie McDonald. But for now, goodbye.